We wait 1 more minute until we start. So I think it's 2 minutes after 11, so we should start. A very warm welcome from our side to today's webinar. We have established a kind of webinar series already about different topics around working capital finance. Today's topic is green finance, promoting and demanding sustainability along the supply chain. It's a topic we from the CRX Markets team are coming across, I would say, in almost every client discussion we're having. And it is our goal today to give you a bit of background, what is meant by ESG in the context of finance, trade finance, and I think this is a very important part to show you also some use cases in this regard. If you have any questions during the course of this webinar, feel free to drop them in the chat. We can see them. We will tackle them as soon as possible. And before we go into the agenda, I would like to introduce ourselves so that you know who is here with you. I would just start. My name is Daniel, heading the business development at CRX Markets. So I'm talking a lot with clients, and as I said, ESG, green finance, and all of these buzzwords are very present in all of the client discussions we're having. And I'm very much looking forward to this webinar today with you.
Thanks. Yeah, my name is Michael, and I'm looking into the matter of account management. I'm managing the large client accounts we do have here on the CRX platform. In all aspects of working capital finance activities they may have, and that starts at the structural phase at the very first discussions and goes up to the scaling of the existing programs. And as Daniel has already mentioned in his intro, ESG is nowadays a real hot topic in the most client discussions we have.
So what is our plan for today? You should see the agenda now. Now, perfect. So what is our plan for today? First of all, we would like to give you a very brief introduction of CRX Markets for those who may not know us. Then it's a bit of a really deep dive into the topic of ESG, which is Michael giving you. He's kind of our ESG expert here at the CRX Markets. And then to round this up, we will give you some real case studies, showcases about projects we have already rolled out or are currently in the rollout phase. And then, of course, you have time for asking your questions. The whole webinar will last roughly 30 to 40 minutes, so to also have some time for Q&A in the end. So who is CRX Markets? We are a working capital finance marketplace offering various working capital finance solutions on our platform. So what we did is we built an infrastructure where we connect corporates with financing parties and offer different ways, products in the field of working capital finance. We were founded, or we went live in 2015. We started in the field of approved payables finance. It's also referred to as supply chain finance. I think this is kind of the focus topic also for today. In this field, we offer a broad variety of solutions, being it dynamic discounting solutions, where a corporation can make use of its own excess liquidity to offer the suppliers the early payment of invoices. Or on the other side, you can also include external funders, being it banks or non-bank investors, to pay the suppliers earlier in different models. Our kind of latest solution we are offering is in the field of receivables finance. Here we address suppliers directly who can sell via the marketplace their unapproved invoices directly to a broad pool of financing partners. Last year, we financed via the CRX Marketplace 10 billion in invoice volume. For this year, we are aiming to double this figure, so to finance 20 billion in financing volume. And this volume is financed primarily by a broad pool of financing parties, which you can see on the right side. So we are a bank independent platform. This means based on our clients' needs, we onboard financing parties. And this is, I think, today more than 50 financing parties. This can be banks, asset managers, but also factoring companies are active funders in our different programs. On the left side, you can see some of our selected clients. They are active in different programs, being it on the receivables or on the payable side, and we cover these clients globally, especially as you can imagine in the field of supply chain finance. The supply chains are global, so you have to go with your clients, and this is why we are active in more than 55 countries in different jurisdictions with different supply chain finance or receivables finance programs. One aspect which is important for today is the ESG criteria. This is something quite new. So we also offer a variety of ESG-linked programs on both sides, on the supply chain finance, but also on the receivable finance side. And how we do this and what kind of the background of all this is, this we will show you today in our webinar. And then I would hand over to you, Michael.
Yes, thank you, Daniel. Before jumping into the matter and talking more about the ESG finance background, I would like to conduct a little poll and invite you to answer a few nice questions, please.
We hope you all can see the question. I think the poll is open for roughly a minute.
Okay. Good. First answers start to come in, which is good news. It is working. And I'm excited to see what the picture will tell us, where the people stand, what knowledge they have. And okay, I think that has been sufficient opportunity to push some radio buttons. Can we share the results with the audience? Okay. So no contribution yet. This is more interesting. Everybody here in the audience is already engaged somehow in ESG financing matters.
Which is good news, yeah.
Which is pretty good news. So obviously we do have a highly educated and informed audience. Most of the panel of the people have shared the information that they do already have a long-term sustainable finance strategy in place. So I think a good environment to continue here with our content of the webinar. Yeah, before we show, we do have a deep dive into some use cases as announced by Daniel. I think it's worth to spend some minutes with the background of ESG, and in particular nowadays in these uncertain economic situation characterized by uncertainty in respect to geopolitical risks, high inflation pressure, volatile commodity prices, and also disruptions in the supply chain. Many people start wondering if ESG will still keep the relevance and the attendance it has had in the last couple of years. And to answer this question, I simply collected some headlines from ESG Today, which, by the way, is a nice source for gathering information with relevance to the ESG developments in any aspect. And let's see how that works out. So kickoff was made by ING, who announced at the beginning of last week that they will give a major boost to renewable energy finance, and more interestingly, that they definitely will exit financing of new oil and gas projects, in particular in those days where we have supply constraints, concerns. The bank steadily announced we will get out of this. They have been followed by SEC, who unveiled their climate disclosure rules. Next step was IFRS and GRI. Maybe this is not known that GRI, Global Reporting Initiative, agreed to align their disclosure standards in respect to sustainability. And last not least, oil and gas dinosaur BP announced that they intend to invest only in the UK market at least 1 billion for electric vehicle charging networks. So in a nutshell, we see all large organizations, may it be corporations, may it be banks, but also standard setters and regulators, continue on their path to anchor ESG on the agenda of every entrepreneurial business, I would say.
And this is only last week.
And this is only last week, and it's very recent. So I think the strategic scene is still unchanged. Okay, sorry, that was a bit too fast. One slide back. If we talk about sustainable supply chain finance, then I think it's important to understand why corporate treasurers and also procurement organizations currently have paid that high attention for sustainable supply chain finance. And there are many aspects who are driving that interest. I picked out, I think, two which have a very important role in that aspect. First of all, I'd like to touch on the EU taxonomy. This is a piece of regulation which is dedicated to boost private sector investments into green and sustainable projects. And it's a very extensive paper, but to put it in a nutshell, it clearly lays out which are impact industries in the sense of good and bad industries. So you may remember the discussion about nuclear power plants. Is it a good or is it a bad impact industry very recently? And more importantly, it sets out some regulatory obligations, in particular in respect to disclosure. And this affects, for the time being, large corporates and all financial market participants, and it will extend, I think, in 2023 also to SMEs. And these disclosure rules are mainly about to disclose activities that substantially contribute to climate change mitigation or adoption of climate change. And many participants in the markets and financial markets have recognized this being, or their contribution, being a competitive factor in the market and a very positive image driver. And this explains why many financial market players are heavily seeking ESG-related investment opportunities. And this demand is such strong that we in some aspects even see that terms and conditions are about to ease, prices are about to lower a little, and this calls the corporate treasurers to the plan, who clearly see the opportunity to structure ESG-related financing to obtain some benefits for their corporate treasury funding. On the other hand, another important driver is the greenhouse gas protocol, and by the way, we have touched in the headlines already the alignment of IFRS and GRI disclosure rules. And the greenhouse gas protocol, by the way, is in respect to all greenhouse gas pollution already the standard within GRI disclosures. So, and it's there already since 20 years. It's a standard to measure and manage greenhouse gas emissions. It's even a mandatory reporting standard in some European countries like France and UK, and many of the Fortune 500 companies are on a voluntary basis already following that disclosure rules since a couple of years. And most importantly, what we have to know about this greenhouse gas protocol, that it distinguished between three areas, scopes, to which emissions can be signed. Scope 1, direct emissions, which typically arose from sources within a company, a production plant. Scope 2 are indirect emissions from electricity, power, gas, whatever purchased externally. And interestingly, these two scopes can be controlled directly by an organization. So if you run, let's say, a smelter, you can decide to apply some efficiency measures to increase the efficiency of that facility, for example. Or if you purchase electricity, you are the owner of the contract, and you could easily decide to switch from a conventional electricity power contract to a more renewable power contract. So that's easy to manage from a corporate organization perspective. But more interesting is the so-called scope 3. It's interesting because it's complex, and by the way, it's also the scope which has in many industries the highest relevance. The highest share of pollution comes from scope 3. And scope 3 touches on all indirect pollutions, which are more or less related also to the supply chain. Not only limited, it also includes pollutions from business travel, from commuting or anything else, but also the supply chain. So everything which is related to the purchase of products, the transport of products, and so on, this is into scope 3. This goes directly back to the supply chain, and this is why procurement comes in, because now procurement has the task that they have to somehow incentivize, to motivate their supply chain to take some measures to better comply with, for example, CO2 emissions in their business activities. So that's why corporate treasurers and procurement organizations, I think, currently look very interested into the matter of sustainable supply chain finance. The point is, if we talk about sustainable supply chain finance, that we currently do not have in place already established frameworks or principles, as we know from other financial instruments. And typical financial instruments are, for example, green loans, green bonds, which are in place since a couple of years. Also a very similar technique, so-called sustainability-linked loans or bonds, also in place. And for both instruments, we do have accepted in the market accepted principles, which lay out the main characteristics, the main principles, which are set up by a group of LMAs, loan market association members, loan and swap trading associations. So there has been incorporated and evolved a market standard for these instruments. This is not the case for sustainable supply chain finance, but of course, these principles can build the base also to develop sustainability linked supply chain finance or working capital programs. And if we take a look into some of the main principles in respect to the loans, for example, a very core principle is the use of proceeds. You're only allowed to use the proceeds you generate from a green loan for a very clear and agreed purpose, which has been accepted by the investors. And there are very strict principles in respect to the process of the evaluation of appropriate projects, but also in respect to the management of the proceeds and the following reporting. Different way to combine ESG KPIs with financing are the so-called sustainability-linked loans. They clearly aim to facilitate and support environmentally activities, and their core components are, for example, the calibration of sustainability performance targets. What does that mean? Is a sustainability KPI, is that in line with the corporate strategy, for example? Is it ambitious? Is it the right KPI? So selection of KPIs plays an important role. The loan characteristics, that means which impact does the achievement of KPIs have? Will there be paid a malus or a bonus, for example, in respect to the terms and conditions? And reporting and validation of the whole structure plays an important role as well. And yeah, as said, these principles could also be applied for a sustainable or working capital finance scheme. To continue with some terminology, use of proceed principles in respect to sustainable loans, we have already touched on that. I think it's important to understand that these principles do not give a yes or no to certain projects. It's more about the framework which is available, which should be considered to really achieve the status of a green loan, for example. And to give some examples, what could be financed by using a green loan? Of course, the investment into offshore, as we have noted by ENG, energy efficiency measurements, etc. Everything which is going into that direction could be used for the proceeds of a green loan. But again, it has to be agreed and clearly explained before structuring the loan. If it comes to the sustainability-linked loans, for example, the main difference is the purpose of these funding is also available for general corporate purposes. So there is no clear use of proceeds rule. You can do what you want with the proceeds of such kind of loans. And it is clearly dedicated to incentivize the borrower's achievement of hopefully ambitious, but in any case, pre-agreed sustainability KPIs. And of course, sustainability-linked loans should have a relationship to the corporate overall sustainability strategy. And this is a very important aspect. Of course, the investors expect a reporting. How does a corporate comply with the KPIs? How is the KPI achievement going, and all that stuff. And as said, these principles could easily be transferred to any sustainable supply chain finance scheme. So last but not least, if we now look to the options a corporate organization has at hand, how to structure a sustainability supply chain finance offer, for example, we can roughly group that into 3 segments. A very popular one is the first one, where corporates intend to use very established ESG rating providers, namely organizations like EcoVadis, Sustainalytics, MSI, and others. And there's a clear pro why to do that, because these rating providers do have already a great acceptance in the financial industry. It's a rating principle the industry is familiar with. They have already a brand, and we have seen already a lot of financial instruments referring directly or indirectly to such kind of scores. And not that nice aspect in my eyes is that these most of these ratings and scoring models are very broad-based and very standardized, and very frequently offer only limited room for very individual strategies. And remember the link you should create from a sustainability-linked financing offer to your own corporate targets. Now, it is important, if your corporate target is the reduction of your carbon footprint, for example, many corporates start wondering, does it really make sense to apply such broad-based ESG scoring model? That brings us to the second category, more focused ESG ratings, which have their history in certain industries. Very popular one is UTZ. Most consumers know UTZ scores because this is a standard in the cocoa and also coffee industry. Many products, consumer products, bear that UTZ certificates. FedEx goes into the same direction, but ISO certification, for example, a very, very relevant standard in the manufacturing and production businesses. So pro here is clearly that these more focused rating standards have a higher acceptance. They are already applied in the most industries, and they are clearly better suited for very individual, tailor-made sustainable supply chain offerings. Little challenge is they are more demanding in respect to the integration into financing schemes, because now you start to explain to the financial market why you decided for a combination of UTZ and ZX rating for your supply base, for example, and why is this a good standard? Why is that compliant to EU taxonomy targets or to any other targets being relevant from the financial market participant perspective? And last not least, very interesting, a very straightforward model. You decide for a clear ESG reference, and one of our clients nowadays has started to simply agree to ESG related KPIs. So let's say the reduction of the CO2 emission by 20-30% exemplary until 2030 with its tier 1 suppliers. So incorporated into the supply agreements, and if the supplier achieves it, they will talk about a special incentive in respect to a kickback payment or a bonus payment. If the supplier doesn't achieve it, then there will be a bonus payment for the contractor. They can refer to very well established principles. KPIs they may use may be exactly the same to be applied maybe in sustainability linked loans. So you can create a link from your financial instrument directly into your supply chain. That's a very nice and easy implementation. Probably a disadvantage is that this approach is, I would say, suited in particular for tier 1 suppliers, for large suppliers, for huge investments you have on the agenda, or even huge projects.
So there's one question coming in, and it's about, do you see in your discussions with the clients any preferences to one of these models?
This is, to be honest, this is a mixed bag currently. I think most discussions start on the left-hand side with an easy to implement, with an easy, understandable and achievable process. And if the people dive deeper into the matter, then they recognize, does it really make sense? Does it really brings us closer to the achievement of our corporate strategy if we, let's say, force our supply base to achieve a certain ESG score? Does it really mean that our individual ESG targets are achieved as well? And necessarily it doesn't. And at that point in time, they start to investigate what is more appropriate for us. And last week we had a event here also related to green finance together with Siemens, and they introduced their approach, which is a very individual one, where they developed over the last 3 years a very individual supplier scoring, which compounds of different impact factors. So they're using a little bit of EcoVadis, they're using a little bit of ISO certification, and also a little bit of their own experience and their own assessment, and then they come to their own score which they wish to apply.
Thanks, Michael. So now we're coming to some proper use cases we have on our platform. So supply chain finance and ESG. I think Michael was drawing a very nice picture. It's my feeling that we see, especially in the field of supply chain finance, a kind of paradigm shift. Yeah. So in the past, supply chain finance was very much, it was always collaborative, but it was very much about extending payment terms towards to your suppliers to achieve certain financial KPIs, and in the same way, incentivize your supplier or give them the opportunity for early payment from your financing partners. And what we see now is, in my opinion, an even more collaborative approach, because in order to achieve your own ESG goals, you kind of work together with your suppliers, and when they contribute in terms of scope 3 maybe to your ESG goals, you offer them the early payment of invoices to, for example, do all the relevant investments they have to perform in this regard. And this is for me a very interesting change in this field of supply chain finance. And I think, Michael, also payment term extension, when you look at the unfair trading practices and so on and so forth, is something which is more and more difficult to really stretch payment terms. So we have the feeling here also in the discussions with our clients that supply chain finance is the ideal instrument to work together along the supply chain to achieve your own ESG targets.
Yeah. It's a perfect instrument to align interests. It's very clear. And in the past, the trade-off has been, I provide a supply chain finance program to my supply base, and in turn, I expect some benefit for myself because I have all the hassle to arrange that. I have to provide the bank facilities and so on and so on. And nowadays, the trade-off moves a little. From procurement perspective, we have to recognize that we add another dimension to the supplier relationship. It's no longer only about cost, reliable deliveries, quality, after-sales service. It's now also about ESG achievement and compliance with ESG, and that comes at a cost. Yeah. And the question is, in every negotiation, the question will be, if you expect me to be ESG compliant, who will compensate my offers? And to offer some liquidity, access to liquidity, that could be a nice alignment of interest.
So, looking at the cases, one of our first ESG-linked programs was implemented together with Nestlé. So Nestlé used to be one of our first clients. They have an existing global supply chain finance program, which includes a securitization model in the back for refinancing. And I think 1 or 2 years ago, Nestlé was really proclaiming their Nestlé Net Zero roadmap, which has the clear goal to switch to 100% renewable energy to become carbon neutral by 2025. And for them, it was pretty clear that supply chain finance in general is always a collaborative or collaboration tool. And they pretty quickly realized that they could also use this tool to incentivize their supplier base in order to support Nestlé to achieve these renewable electricity 100% goals by 2025. So what they did is they were kind of pimping their existing supply chain finance structure. So they didn't have to change anything on the whole setup, on the whole structure. What they were doing is they were linking certain suppliers or invoices of suppliers to certificates. It is what this model was explained by Michael already. So there are well-known certificate providers like Rainforest Alliance, UTZ, and so on. And Nestlé is able to link invoices, so deliveries from their suppliers, to these certificates. These certificates, in addition, can be made or are made available to the financing partners, so that they can see, okay, these deliveries from this specific supplier, they are linked to this specific certificate. And what is happening here is when this invoice is then in the ERP system of Nestlé, is linked to a certificate. This is shown on the platform, and these invoices are channeled into dedicated ESG nodes. And in this regard, it is possible for financing partners to specifically invest in Nestlé ESG nodes. I think it's quite important that not all of the spend volume is ESG conform yet, but they are channeling more and more volume into these ESG nodes. I think until now we have financed already 500 billion in ESG nodes in the Nestlé program. But next to this, and they still run this in parallel, they also have their regular purchasing volume, which they are transacting. And what we see is that there are dedicated investors, mostly banks, but it could also be non-bank investors, and they have the capability to provide more attractive financing rates for suppliers being compliant in the regard of this certificate. So this kind of windfall which is created from the investors, it is 100% passed through to the suppliers. And I think compared to the kind of existing or old supply chain finance or non-ESG supply chain finance program, they could profit from, I think, a price decrease of up to 20% roughly. And this incentive was completely passed through, as I said, to the suppliers and incentivizes them to be compliant with these certificates. And it's also used as a marketing instrument across the whole supplier base. So if suppliers are complying with this, they are able to get access to this more attractive financing scheme.
I like this approach. It's very straightforward. It's very pragmatic. Simply use what you have, extend it a little, push or pass on the benefits, full extension to the suppliers. More interestingly, it's on a second glance, it's a more complex approach. Huh? If you talk to the classics or talk about the classics, so that scoring models, they are always applied on the supplier level. Here you go down to the contract level, which makes a difference. So we have to distinguish between contracts which are ESG eligible and contracts or deliveries which are not. And this is very important from the financing perspective. Do I always acquire ESG compliant assets here? And that's what the platform like CRX can ensure. We have received another question from the audience. The question is, could a supplier be an own managed company in origin? And I think this is something we should investigate from a scope 1, scope 2, scope 3 perspective. Yeah, let's clearly from the accounting angle. So is an own managed company, is it part of the consolidation of the accounting entity, or is it not? Then it is already included in scope 1, scope 2. If it's a non-consolidated subsidiary, for example, then of course their pollution would account into scope 3, for example. I hope that answers the question.
So last not least, another example of an ESG supply chain finance program on our platform is in collaboration with EcoVadis. So EcoVadis is the rating provider in this regard, and even though here we have this specific name, I think it's completely, or the platform in general is agnostic to who is the dedicated rating provider. And as Michael said, many corporations are rather looking into a combination of different metrics and ratings rather than focusing only on one. But nevertheless, also I think this approach is, for a start, it's pretty straightforward. It is a standardized process. Also from the financing party perspective, it is pretty well recognized already. So banks know EcoVadis. They're working together already in different aspects. And what is happening here is that next to the buying organization, of course, and the suppliers, also the ESG rating provider is connected with our platform. And from this rating provider, we get, for suppliers onboarded, we get a specific rating on the platform. It can be the rating, so the really the number, let's say. It can also be the supplier is rated or is not rated. So here, I think also solutions have to be flexible. But once this supplier has this ESG check, this ESG rating available on the platform, he might be able to get access to better financing conditions once he fulfills certain criteria. And here it is also like very interesting for me that the final approach is completely different also from corporate to corporate. There are some corporations, they say, okay, if a supplier has a rating at all, I offer them access to this early payment solution. If a supplier has a rating higher than XYZ, then I offer this supplier access to a solution. Or you can even tier the pricing you offer to your suppliers based on the ESG rating, which is shown for the suppliers. I think the general approach is here that based on the availability of a rating or based on a specific rating, a supplier gets incentivized and gets access to better financing conditions once such an external rating is available.
Cool.
We got another question. How long does it take to implement such a ESG solution?
As always in life, there is no simple answer to that. I mean, that clearly depends on what kind of ESG solution you're looking for. Yeah? To implement such a more standard thing like the EcoVadis rating, for example, I would say you have to think about the appropriate ESG rating provider. Is it EcoVadis? Is it another one? Yeah, which has the best fit to your industry and to your individual ESG targets? You make your selection and then you start to roll out it in the supply chain. 3 to 6 months, I would say. Yeah. If it comes to a more difficult assessment of what is my real scope 3 CO2 pollution in my supply chain, what makes the difference of a product which is manufactured in China and transported, shipped over the sea to Europe compared to a product manufactured here in Europe using not coal-fired electricity but renewable electricity, and to evaluate all that details that can take a longer time to even prepare the base for action. And of course, the corporate should have a clear visibility about, let's call it exposure. Yeah? What is my exposure I want to mitigate, I want to manage before I start mitigating it? And I think this is important as well. I mean, it is a very complex project in my eyes, and there are still some things about to change. They are not finally decided. We have only only reporting guidelines for the time being. We don't have even a clue how all that ESG financing will affect, let's assume, regulatory capital of banks and availability of capital for impact industries. Nothing is clear right now, but nevertheless, if corporates want to start, they probably start with a more simple approach like this one, implement it very quickly, make their first experiences, and then later on the road, they move to a more complex structure which better fits to their individual requirements, which of course requires two things: partners who have the technical capabilities to go that journey with you, and also financing partners. I mean, in particular, in a situation where nothing is carved in stone, it is important to have a broad access to as many financing partners as possible to find the perfect fit for your individual ESG financing project. I think that's important.
So before we tackle the last question, just a quick conclusion, I think, on what we're talking about. I think it's pretty clear that, or we hope that we could show you that sustainable supply chain finance is a very nice collaborative tool to align your suppliers with your own ESG targets by incentivizing them when they fulfill certain criteria, ESG criteria, let's say. We see that the goals or how companies, corporations are setting up this is very individual. So it can change from industry to industry, even from in different spend categories. It can be completely different. And there's currently no standard in place. So it is a very individual approach you have to choose here. In order to find this, of course, we're happy to support you in this regard. And we think a platform should be kind of agnostic to all of these different approaches available out there. The last question coming in is, does the ESG solution run also automatically via your ERP integration?
Yes, it does, and it must, in particular in a solution which goes into the direction of Nestlé, which we have introduced, where they really distinguish in their order management orders which have ESG compliance and orders which don't. If you have a more simple solution, if you focus on the supplier scoring, you don't need necessarily the ESG rating of a supplier to take from your ERP solution. This is, for example, with EcoVadis, we have a cooperation. We can integrate and grab the information directly from the EcoVadis platform and share it with the banks, for example. So in that case, ERP integration wouldn't be required. So it depends on, as always.
Perfect. So we are a bit late already. Sorry for that. But it was just an interesting topic with very good questions. If there are no more questions, I think we would say thank you very much. We would close the session. If you want to learn more, go a bit deeper into the discussions on a bilateral basis, just reach out to us. We are happy to follow up with you. And I think then it's on us to wish you a very nice day and talk to you soon. Bye-bye.
Thank you and bye-bye.